that reminded me of.
All right. We are live. Welcome to Let's Talk Markets. We are joined by our favorite recurring guest.
Oh, I thought, okay, fine.
Favorite caveman?
I thought you were going to say D-Gen. All right. I'll take favorite D-Gen.
Also, our favorite D-Gen.
There we go.
Erik from Outlier Trading. Erik, thanks for joining us.
Pleasure to be here. If it looks like my eyes are like a chameleon, it is because the market is moving quite a lot today. So I am intermittently interacting as needed to, it's like, anybody that asks like what I do on a day-to-day, I just lose money all day. Like I just turn on the computer and I just start lighting money on fire, but it's fun to watch the colors. So you have to pay close attention to the colors. That's that's mostly the gist.
Certain drugs are helpful for that.
I've heard
maybe that would help.
I've heard I'm one of those people that I am way
high on life.
I'm just way too obsessed and energetic as is. The last thing
strike me as high on life.
Yeah. I think it would be, I don't know, who knows? It could be fantastic, but I wouldn't know because it's a terrible place for me. But what's new up there in the north? How are you guys doing? Is everything going to plan?
Elbows up. That's what they say now. Elbows up.
Really?
Yeah, that's what they say. Okay, it could not be like you could not have a more Canadian expression. So, what that is, they're talking about is like, get ready to fight in the hockey game, right? You're playing hockey and, someone fights, so elbows up. So,
I thought you guys were doing something like lean like a cholo, because that just goes back to maybe your inexperience with fighting, because elbows up's a terrible strategy. We're gonna have to revamp that too, guys.
No, to be fair, like if you're doing some Muay Thai, right? You're doing some Muay Thai boxing, give one of these, give one of those. That's a pretty vicious move.
Yeah, you can throw an elbow, but then in the meantime, you're going to get...
You don't fight like this?
Yeah, you're going to get a knee to the ribs, a teep kick, and get sat down. So, yeah.
There you go. Canada, an interesting place over the last month for the election. Let me tell you what an election is here. It lasts 1 month.
Okay.
You are not allowed to campaign outside of that month. You're not allowed to put up political signs or anything like that. They call the election. There's a month for the candidates to make their case. They have debates like every week, and then you go vote. And then it's over.
That sucks. Where is the 18 months of chaos in that scenario? What a boring way to do things.
It is. It's a civilized country.
I was thinking for our elections, they should start selling pay-per-views, because people will be buying that to see what kind of...
You're joking. That is obviously going to happen pretty soon. Okay, this is like not even a question. Have you ever seen the movie Idiocracy?
No.
Okay, so let this be a full-throated recommendation to everybody watching. Go watch the movie Idiocracy. Many of you have probably seen it. It was like a documentary they made about the United States, but they made it, 30 years ago? It was like from the 1990s. And it's so disturbingly prescient. Like the central problem that they're trying to confront is they've lost a lot of knowledge in the far future, and they're trying to figure out why their plants don't grow, because they're like watering their fields with Gatorade. Because plants want electrolytes.
I see.
Believe me, we're very close.
We're
very close.
I'm typically pretty sus on your recommendations after you sent me on a Wagyu.
Oh, here we go again.
I'm telling you, I've never committed so hard to trying a food I didn't like as much as this.
Your railing against it has like turned me off of it. Okay, now I'm not. I haven't had it in months.
It's not turning you off of it. It's just breaking you out of this false world you made for yourself, as if this is some incredible.
Every time. All right. So anyway, back to Canada.
Okay, fine.
We turned away. So actually, what I read that this could have been historically one of the most dramatic electoral shifts in all of history.
Interesting.
A month ago, 2 months ago, the Conservatives were polling up, I think, 22 points at one point. And then Trump comes out with the 51st state stuff. The conservative leader does not respond forcefully.
I see.
Trudeau resigns. They pick a new leader, Mark Carney. He comes out as pro-Canada as you can be. And the polls swung so hard that the unthinkable happened this week, and the Liberals won another term to run the country into the ground, to run the country. And it was really a shocking result. So they went from down 22 points to like ending up 4 points in literally like 6 weeks.
Is it as divisive there as it is here?
You know, it's funny. It's not even close.
Okay.
But they would consider it very divisive, right? They're like, hey, listen, I'm sorry there, buddy, but you know, I got to disagree with you on this very particular piece of wonky policy. It's like, hey, it's no, I'm sorry. Listen, you listen here, friend. You know, I have to say that you are not quite right on that. No, listen, buddy, no, I'm sorry, but you know, it's like every single thing. But I'm kidding, but I was talking about this. The electoral divisions here are very different. So like the Liberals are like not quite AOC Bernie left, and the Conservatives are like Clinton left.
That's so lame. You guys,
and then like you have a party over here with the NDP, which is like true AOC Bernie.
There we go.
And then you got some fringe Green Party and People's Party that are way, and they get like 1 or 2%. But you know, like 80, what was it? No. So like 49% and 44%. So like, you know, 93% of the electorate voted for what would essentially in the US be divisions of the Democratic Party.
Right.
And, you know, yeah, the Conservatives moved a little more right. And in some provinces like Alberta, the Conservative Party believes different things than like I think the broader federal Conservative Party. But no, it's a very different political landscape. Like there are things that are just not up for debate here. Like gun manufacturers do not have a powerful lobbying group that forces, you know, semi-automatic rifles on people here.
Yeah, that sucks.
And, you know, you never have to worry about school shootings, and, you know, big pharma doesn't drive healthcare here. So you don't have medical bankruptcies. You know, it's like things like that are just sort of not up for debate.
Right.
But you know, the size of government is the big issue, I think.
Now, with the tariffs and stuff from like a market lens, what's the perception been like at the deck plate level, like for the people on a day to day? I know that there's, you know, buy Canadian, support Canada, which is awesome, right? Anytime you see nationalism like that, you want to see that. You want to see cultures and people like that.
Oh yeah, Trump has brought Canada together like nobody else could.
Yeah, which is honestly
in a shocking way.
That's a very cool thing to me. But that aside, from like a day-to-day operation lens, how are you seeing that play out there?
You know, I mean, prices are already kind of high here. The cost of living is high. So I haven't particularly noticed a huge impact, but things were already kind of expensive. So I think like there's room for absorbing it here.
Okay.
I will say this: eggs have always been reasonably priced, and like, you know, you can get $4 a dozen here, no problem.
I literally, I have no idea how much they cost. It's like, it's one of the things I have noticed about like being fortunate and like starting to like create a little bit of success in that way. I have become kind of price insensitive. That's actually why I like asking, just because I know that you're also in that place, but you're just more thoughtful than I am. So it's like,
I do my own shopping, you know.
Yeah,
I've stopped buying Wagyu because of the prices. Right? Like everyone's feeling the pinch. Okay.
Listen, if Wagyu falling off, that's a good thing. Everybody
okay. All right.
Off that.
All right. So, but here's what I think: the tariffs are bad for Canada, but it's ended up being he delayed what he said he was going to do, and then ultimately the way that he tariffed Canada is that only goods that are not USMCA compliant, which is, here's a funny story, right? USMCA, that's what they call the new NAFTA in the US, but they don't call it that here. Here it's called like CAMUS.
Good.
Like because it's Canada, Mexico, US, but in the US it's US, Mexico, Canada. I don't even know what do they call it in Mexico. It's like
you know, the Masca, whatever. I'm sure they'll figure it out.
So it's only on goods that are not USMCA compliant, and I don't think that's a ton of stuff. I will say this: they have definitely destroyed the baseball card grading market.
Thank God, because if we have to have another 40-minute conversation about taking magnifying glasses, looking at fringes of cards, I honestly think gouging out my eyes is just more engaging. Joking aside, it actually is kind of fascinating. Anytime I hear people that get really into collectibles, it's just insane how niche that gets. But back out to like the day-to-day Canadian and like just what you're seeing out there. So it sounds like prices generally already high, not seeing a massive spike in anything just yet. It seems like with the compliant exclusion carve out, a shocker, another carve out, it seems like it might not be actually quite as bad. Is that about
that's I think the tariffs on China are obviously the most dramatic thing in the trade war.
Hell yeah.
The fact that they delayed most of the rest of the tariffs, I think is a good thing. Although, we saw US Q1 GDP come out negative, which was pretty shocking from a couple months ago.
Yes.
Probably, in fact, very likely on pace for Q2 to be negative. So let's talk. I mean, increases the odds of the Fed cutting rates for sure.
Market liked it.
And so, all right, let's talk about markets. So we've got we've got Trump's first 100 days. Obviously, Urvin we are not a political organization. We like to say we're as purple as we come. We're not here to tell you who we like, who we vote for, what we think, anything about really general policy issues. We're here to talk about markets.
Yes.
And so, with that in mind, generally you talk about, well, what's happened in the first 100 days of an administration. The S&P 500 posted its worst first 100 days in a presidential administration in 50 years, declining by 7.9% from inauguration day to April 25th. Nixon's second term was worse. That was down almost 10%. And this is pretty different from his first term, where in the first 100 days it gained 5%. Trump has said, this is the Trump market. You're going to love it. Then it didn't perform so well. Now it's the Biden market. He's got some overhang. Okay, whatever. What do you think? You watch the market very closely on a day-to-day basis. What has been driving the movements from your perspective? What do you think is the most important factor?
It's funny because like anybody that talks about markets, I hate summarizing stuff into like a simple, neat sentence and pretending that's all there is to it. But in this case, I
totally agree.
I actually think there's a bit of a lens to that now. And I really think if I were to classify primary driver right now, it is what Trump comes out with when. And in terms of the launch of the tariffs, perfect example. Before the tariffs were launched, he's saying, oh, I think we're going nicer than we could and this, that, and the other thing. And then all of a sudden, the first thing he does, like Stone Cold Steve Austin, glass shatters, everybody gets 10% tariff. Let's start there. And the market's like, what, bro?
What?
We're going chill. So then the market.
I don't want to know what the other option was.
I don't want to know what else is easier than this on people. So like that just sends people reeling. So I think that's a massive, massive driver. So if I were to sum that up one level closer, it's volatility. And from an options trader lens, this is Christmas. This literally is Christmas. The more mayhem, the better. And it's because when there's big dislocation between market expectations and price, yields opportunity. Because nobody knows how to price it. You can't price what Trump's next truth is going to be because nobody knows. So I think when we look at a lot of the near-term market behavior from my own lens, I think a lot of it comes down to trying to understand what the hell is going on compared to what is being said versus what's going to happen. And that makes it really difficult to price things. You think of it from the lens, again, going back to tariffs. It's a prime example that most people are familiar with. In the beginning, there was no, I'm just kidding. In the beginning, Trump was saying, there's not going to be a bunch of carve-outs. I can't even keep track of them all at this point. It's like if a car is manufactured mostly in the US, then that's okay. And then you get a 3% rebate. And it's like, it's been nothing but carve-outs, which again, I don't disagree with in terms of the implementation and stuff. You're trying to figure out how to do a lot of things. But as a market that's trying to
you could have figured that out before you did the thing.
One of my hunches is that this hasn't gone as anticipated, to the effect of trying to come out really strong and to try and capitulate people very quickly. And then as the reality, they've a lot of countries have been through this, right? They've been through a first term. They know there's a lot of bluster. And there's often, time is on your side when dealing with it, right? Especially with a lot of the countries that we're dealing with. Again, I always mention this to people because from like a I speak from an American perspective primarily, but I imagine it's probably similar there, where we're dealing with other countries that are literally dealing in decades. China doesn't care what happens next year, 2 years from now. Sure. They're thinking in multi-decade timeframes. So it's really interesting to see the navigation of this whole thing. But I think top line, largest driver of market activity is going to come down to that. It's down.
And it's very much like when I saw the ISM came out today, I think it was something like 48 and change, which was maybe a bit better than people had thought, though still, contractionary. But the quotes from there, the word tariff was in almost every single one of them. Right. And the level of confusion and uncertainty that it's unleashed has increased volatility, right? Because it's hard to know what to expect when, and then it's hard to know because of exactly what you're talking about. Like these carve-outs, first of all, unfortunately, in a situation like this, open the door for corruption, tremendous corruption. But at the same, I think at the same time, they just lead to so much uncertainty, because you hear a tariff rate and then you try to adjust for it. And then maybe something gets carved out, maybe it doesn't. And you really have no idea
exactly
what it's going to mean. And so, I mean, it's been fascinating to watch the market. What do you think? Let's take a specific thing. What do you think? Have you watched crude at all?
Yeah, of course.
Do you watch that? Like, under $60 right now, that's a big deal, right? What do you think? What do you think is going on there? Is that a statement on demand? Is that weak demand, or is that a lot of supply, or is it something else?
Yeah, I mean, I don't necessarily think that's coming from softening demand totally, but I think that this has been one of the main things that Trump was trying to campaign on, and trying to drive oil just, cheaper day to day for Americans. And a big part of that comes through oil. And then we're also seeing OPEC behave a little softer here than previously. So I think there's a massive series of dynamics going on specifically with oil that really amounts to, in the near term, I mean, oil continuing to be suppressed seems to be likely.
OPEC was surprisingly, in a statement, they're surprisingly soft, saying they can deal with lower prices for a while.
Yep. And to me, part of this is, with how the administration is approaching things, it's kind of like selectively setting fires. Because if you set everything ablaze, then you really have nothing to lean on. But one of the things that Trump is wise enough to do in all of this chaos is definitely try to find little pockets that he can point to. And one of my favorite things to listen to are these different, they call them gaggles. I forgot who does them. It's like Bloomberg or something, but it's like just these passive conversations. It's actually really cool to have that kind of access to any president, regardless if it's him, somebody else. I would listen to them from anybody because it's way less rehearsed. And it's like when they're standing on Air Force One transiting somewhere. And it's just a bunch of reporters asking whatever's coming up. Yeah. And it's one of the things that you hear them point to. So I actually think, unlike rates, which he clearly cannot control as much as he wants to.
As much as he does. Yeah.
He does have a little bit of say in terms of how he incentivizes things. Okay. So I think that's
what's the most interesting thing that's come out of these gaggles?
It's a really fascinating question. I think the most interesting thing from my lens is the seeming communication. So I don't want to call it quite transparency because I know it's tactical and I know that things aren't truly transparent at any point. So it's not, naive in that sense. But I feel like it's much easier to at least have an idea of what's going on in a day-to-day basis compared to previous times. Now, that's slightly countered by the amount of chaos, right? Because some of the things we talk about in the gaggles changes to something else when it actually is announced. But it does actually help, I think, quite a lot with at least forecasting a little bit some sort of sentiment, right? So again, back to tariffs. It was no surprise that this big tariff thing came out. And although the 10% thing, base tariff, was definitely different than we anticipated, a lot of that other stuff actually fell generally in line with expectations. And a lot of that does come through from those kind of communications. So I think that's a big thing. I also would offer an inside look from a military lens, obviously with my background. The dynamics on this Russia-Ukraine war negotiation is unbelievably fascinating to me. It is absolutely incredible to try to understand like everything that's going on there. And those quote unquote gaggles provide quite a bit of insight into that. You also have to listen to the other sides directly, but yeah.
That's fascinating. Okay, let's talk about that. I mean, they just signed the minerals deal. Mm-hmm. I thought that was to me, that's a huge step forward. Mm-hmm. If I was Russia, I would take that as a massive loss. That like seems to create a level of integration and between the U.S. and Ukraine and incentives for the U.S. to and economic incentives, not just the mineral rights, but the fact that now any additional aid is more like debt that will be repaid. And there are security guarantees. This seems like a really big deal. I will admit, one that I did not think was going to get signed, especially after that sort of cluster of Oval Office meeting.
I actually think that Oval Office meeting, again, like that's one of the cool things I like about this is you get to see a little bit more behind the curtain than you typically would see. So the fact that we see that and we call it a cluster, to me, I imagine that's a standard conversation between these different groups that most of the time you just don't see.
Okay.
So and it's because you have to appreciate the perspective of everybody at play here. Now, the minerals deal, to me, I actually thought it would have been signed sooner. And the way that the negotiations have played out and some of the decisions by places like Russia, especially during some of these negotiations, to have pretty serious attacks underway, it just sets a tone lens that makes it easier. Makes it way easier. So I think that to your exact point, that's one of the main benefits of the minerals deal, not just from a U.S. lens, right? Because from a U.S. lens, there is a selfish lens of we need it. And this,
for sure,
this also,
I mean, I think it's brilliant on both sides, right? Like the U.S., it helps diversify away from China for these critical minerals to an ally who is really beholden to us. And from the Ukrainian perspective, you solidify the relationship with the U.S. during a time of uncertainty when look, Ukraine couldn't. I don't think Ukraine was sure which way this was going to go, given Vance's previous statements on Ukraine, given what Trump has said.
I think,
right? Like this to me, if I'm Ukraine, I'm so happy.
Yeah.
If I'm the U.S., I'm pretty thrilled. If I'm Russia, I'm pretty upset. Do you think Russia misplayed that hand?
Russia, I think, started opening the door to this kind of thing with all of the involvement from North Korea. As soon as that became wider and wider known that there's this much external support from other countries, it makes it way easier because now it's this game of slow escalation and response to one another. So I think Russia is really interesting with the way that they're playing this, just from like a strategic and tactical level. And I will not pretend as if I know what's going on there better than anybody else. I spent a lot of time studying it, but I know full well enough at this point that any issue like this is so incredibly complex that we only see a tiny piece of it. But what I will say is Russia is another one of these countries that is not thinking in terms of near term. They're thinking in terms of preparatory setting conditions for longer term stuff. So I think the benefit to all of this, though, from a market lens, is this does start to seem like this conflict is more likely to be quelled than not. And even if it continues at its current pace for some time, I think that that's a lot different than it escalating massively.
Yeah. No, I think, for if you're someone who wants peace, this was to me a really excellent step forward, and a really important one. And so, boy, I hope that's right. It's been too much for too long. It's been a horrific conflict. We get a lot of Ukrainian refugees in Canada. A lot to come to the U.S. It's heartbreaking.
Fun story on that. When we were in Ireland, frolicking around looking for leprechauns, which, fun fact, I saw 0, by the way. 0 pots of gold, 0 leprechauns. So a little flustered.
Really?
Yeah, not even
That's
one.
Some false advertising.
I was a little flustered because I thought that instead of watching...
You called the Irish Tourism Board?
I saw rainbows, and we tried to find the end of the rainbow, and I saw nothing there.
Nothing.
As we were looking, we did come across a couple hotels there that are completely closed, and they're saying that they're housing refugees.
Yeah.
And that they, would come back online next season. So it just reinforces the displacement component that you're talking about.
Yeah, Urvin actually has a Ukrainian refugee that works for us, and she started working for us living in Ukraine before the war.
Yep.
And it was crazy. It was just so at the time, just so unexpected and insane to live through for her, and horrifying. Anyway, but let's get back to, okay, so when you're looking at the options market, what is it telling you today about what this next, I don't know, what does the rest of the quarter kind of look like from the options market's perspective?
I really think it's hard, at least for the way that I trade. It's like super, super difficult to look out over a quarter time frame, to be honest. Even if I look at dealer positioning, it changes way too fast. Okay. Most of the lenses that I try to use to analyze positioning is way shorter term time frame than that. So maybe like a month.
Okay, so let's talk about the next. That's fine. Let's talk about the next month.
Just in complete transparency, I have a bunch of things that I'll track for longer term time frames, but there's a way less powerful P-score essentially tied to it. And it's just because conditions, especially now, that's one of the things I noticed with markets like this. When things are so news driven, I always tighten everything up. And most of the stuff that I'm trading now is much shorter term time frame. But like, for example, if you look inside VIX, today's a perfect day. There's 348,000 calls that traded. 22% of those came in below the bid. And on the put side, 167,000 puts, 22% of those came in above the offer, right? So you can immediately start piecing together some of what this is telling you. And this is mostly out in 21 May.
Okay, so people are selling vol.
Yeah, yep. And what they're looking to do is it's definitely a bullish stance on VIX. And you're seeing people even being willing to cough up for those puts is typically quite telling, because puts right now, especially with VIX in the 20 handle, they're very expensive on a relative scale, but people don't care. We've already seen massive rotation on out of just ETF outflows. And I think the recent earnings releases that you see is a bit of a bolster. And I think that was really well received, because the market, I still call this a really jittery market, meaning it essentially can just teeter either way. There's not really a defined trend that I'm seeing, other than the fact that vol is clustering quite high. Another note that I think is worth mentioning is if you look at the COT report, for those unfamiliar with what that is, it just kind of shows positioning for different entities. And one of those entities is large speculators. So large speculators has a certain definition, doesn't really matter. It's typically quite a bit of money. And one of the things I find really interesting about the large speculator positioning is even on the rally that we've seen so far, they've not been buying it. And the latest report came out mid last week. So they're still rolling deeper and deeper net short on like E-minis. So again, hedging positions.
Yeah, so that's like, I think that's sort of the foundational question of markets today is, you know, is this a bull trap? Are we watching like a dead cat bounce? And there's another leg, another leg coming down? Or is this a market that's recovering after, you know, a dislocation and an infusion of volatility and uncertainty, and with the expectation that now everything will get more certain over time, the trade deals will happen, the tariffs will start to be peeled away, the inflation that results from these things will be, dare I say, transitory. You know, the sort of just yes, but this is actually like an excellent example of what can be transitory inflation. Like there's a temporary shock, and then then it dissipates. So you know, do you see any indicators to sort of help answer that question? I mean, you just said that the COT is showing increasing short positions, or you know, they're not buying the rally. Is that telling you there's another leg down?
Not inherently. I think that it just shows cautious positioning, because we also saw massive raising of cash across the board. And if a lot of these places really speculated that this is going to be another massive leg down, you would see the shorts coming on hard, but they're really not. I think what I more broadly take it as waiting to see how the cards fall. And this goes back to what we were talking about earlier. What are the major market drivers? A big part of that is how these tariffs play out, because if the tariffs go the way of just gross acceleration between these different countries, that is literally catastrophic. And
there's no winner in a trade war.
That will crush markets. So there is that possibility that's not trivial with massive severity. Then you have the pace of how things are going. And I'm sure, again, you've seen this from your lens. It started with no carve-outs. Then it started with, well, let's delay autos for a month. Yeah. Then it's, let's delay tariffs for 90 days. So it's like, there's a shit ton of carve-outs. And what that immediately signals to me is that there's not really an appetite to ride this into the dirt. So I think from at least a near-term price performance lens, I actually view it more as a likely period of continued consolidation as compared to some sort of V-shaped recovery. But I also am not seeing massive signals of like some sort of massive leg down, but it's literally one bad news piece away from that.
So let's if you don't mind, I'd really like to spend a little time understanding, you know, we always talk about sort of how you see the market and what you're seeing going on, but I'd really like to understand more about your trading strategy.
Yeah, for sure.
You know, why don't you walk us through some of the basics of it?
Yeah, markets now, like I was telling you earlier, from a vol, well, just from an options trader's lens, like vol is life. Whether you're trying to buy premium or sell premium, you still need vol. You don't want to overpay for it if you're buying, and you'd like to sell it high if you're selling. But that aside, without volatility, without movement, options suck. There's really not a lot to do. Yeah. So with markets like this, there's a few things that I lean really heavily into. I almost always maintain a core position that it's through what I call a covered strangle. And it's like a wheel surrogate, the way to
It's like what Homer does to Bart.
Yeah, exactly. just like that. And it's essentially like a wheel surrogate.
It's a wheel. Okay.
Yeah, it has a couple additional nuances. So typically a wheel is when you buy shares, well, sell puts until you're assigned, hold shares, sell calls against it. The difference between that and a covered strangle is I will sell puts, I will have shares, and I will sell calls at a ratio. So the short puts and the long equity leg can occur simultaneously, not inherently, but it can. And then whenever I'm putting on short calls, that's always a secondary component, because the main profit mechanism for any long equity holding is not what you're going to collect from a short call. It's going to be price appreciation. And I always think that's a massive rookie mistake, that retail traders mimic institutions without understanding the nuance between these, what the goals are for both of these. and we're capping our upside while holding the downside risk. That makes sense.
So when you're selling calls against this position, like how far out of the money you're trying? Obviously, not to get assigned.
Depends.
You just want to be collecting premium?
Depends. Okay. Because part of the way that I trade the coverage strangle is through a value averaging. So what that means is I don't want to just use the short puts to accumulate at different prices, but I also want to unwind inventory as we're seeing near-term rallies, because I'm essentially playing the ebb and flow of things. And some of the major things I trade for that are leveraged ETFs now. Okay. Used to be typically just standard ETFs, but with this kind of volatility, straight into leverage ETFs happily. So I'm trading things like SSO, which is 2 times leveraged, S&P 500 ETF, UPRO, TQs, like that grouping in general. Okay. So the short call component is designed actually as a way to take in premium and just manage as things are cycling, but I do use it as a value averaging leg, because a lot of people get the concept of dollar cost averaging, right? You just continually buy, and then, sometimes you buy high, sometimes you buy low, but you get a decent price over time. But we completely forget its very close cousin that is a massive amplifier, which is value averaging. And the ability to offload when you're selling inventory, again, it's never going to be top tick, bottom tick. But if you sell inventory when it's relatively high, then when it goes down, you can just literally accumulate more units than you could have before with the profits that you made from that rally. And you just rinse and repeat. That's kind of like the background. It's super boring. It's something that's just underway. And the bell of the ball for me now is volatility trading. So it's trading index vol. It's trading relative vol between term structure. Earnings is one of the massive things that I'm doing now. Earnings season is always, it's great because you don't really have to think about a whole lot of other stuff. I normally keep some sort of directional trades on to balance out deltas, but those are really basic ideas. Either selling calls, buying calls. It's like generally single leg strategies. Now I slightly favor selling strategies because of where vol is, but that's kind of like a broad look at the book. If there's anything in there that's worth double clicking into, obviously happy to.
Yeah, well, let's talk about how you trade vol. I mean, you talked about a couple of different things, so let's go deeper into that. What does what are the things you're looking for? How are you sort of oriented right now? Are you also sort of selling vol at the moment, or is it that now that it's sort of now that the VIX has kind of collapsed, are you on the other side?
Now it's actually a holding pattern, because the move in vol directly has kind of happened. So when I'm trading vol outright, vol itself, this is when we're in a clustering phase like this, not much for me to do. I try to catch it in the transitory phases. Now for index vol, it's open season. Like today, for example, the beginning move in the SPX, it hit a low of 56.06, hit a high of 56.58. That's a decent intraday move.
Big move. Yeah.
Lots of trading to do there. That's stuff through like short strangles typically, and I'll tilt them slightly. But I mean, zero DTEs are a big part of what I do now. And I've essentially been trading those since they released. They're really good if you understand what they are, but a lot of people find their way into zero DTEs because they think it's fast, easy money. And you overwhelmingly are likely going to get burnt to a crisp with that mentality. It's way more of a slow, grindy, like yesterday, zero DTEs, full loss. It's going to happen. Yeah. So then whenever those occur, they offset a number of winners, and it's literally just a game of trying to place trades at size when the vol looks good and the range looks good, kind of like it does now. I say that
picking up nickels in front of a steamroller.
Yeah, I like that analogy, but then I always tell people it's a terrible analogy because a steamroller is pretty fucking slow. So if you get ran over by a steamroller, what are you doing? So yeah, I like to think I'm a little more agile than that. But
because you once made a comment, and I had sort of made an offhanded comment. I don't remember when this was, a while ago in one of our earlier episodes, that the zero DTEs are like the casino, and you sort of we didn't go into it, but I remember you were like, well, not really. Not if you have a different approach to them. And so was one of the things I wanted to ask you about. So
it's beautiful.
Yeah. So how do you approach zero DTEs so that they're paying you rather than paying the house? Are you the house?
Nobody's the house. Let's just, the market is always
Citadel's the house.
Yeah. You are never the house. But the thing about zero DTEs is you have to think about who, and you would know this better than anybody else, who would the primary users of a zero DTE be? Dave, any ideas?
The primary users?
Yeah. Who would be really attractive?
Mostly, I think, well, it started out as a highly retail-oriented product. But, institutions have moved pretty heavily into this. Right?
Yeah. And of course, because even from any sort of active trading book from an institutional side, think of how tactical you can manage your overall book just with that kind of positioning. So there's a really large use case for them. And it's just like trading variance risk premiums in anything else. There's nothing sexy. There's nothing crazy, nuanced about it. You are literally taking risk for other people. That's the game. I will take your risk. And my job when I'm trading things like zero DTEs is to make sure that the risk I'm taking is good. That doesn't mean that it's going to work out. I can take plenty of good risk that loses money. Sure. But it is the thing in the aggregate that eventually pays. So a great example of that is like with zero DTEs, depending on your system, how you choose your entries and all this kind of stuff, typical nuance. But what you'll find is a lot of times in the options world, people will say things like, well, you should sell vol when vol is high, buy vol when vol is low. And it's a good idea, right? It sounds generally correct. But if what you're trading is not inherently the movement of vol, but the relationship between implied vol and realized vol, then that rule doesn't necessarily apply as much. And what you'll find is some of the best periods to sell vol is actually when vol is relatively low and realized vol is low, because I'm just trading the relationship between vols. So go ahead. Sorry.
Yeah. So one of our comments, don't forget IV. So but that's what you're talking about, implied vol versus realized vol. Right?
Yeah. Sorry, I don't mean to be lazy with the parlance. So in this context, when I'm saying vol, I'm definitely talking about forward vol. And when I'm referring to historic vol, typically call it historic or realized vol. But that's exactly correct. Because when we're talking about something like variance risk premiums, it's an egregiously simple concept. It is the idea that implied vol tends to be overpriced relative to realized vol. And we can see that across insurance markets. We can see that in the indices all day. And it's the kind of edge that's there. It's persistent. It's not always there, but generally it is. So if you can find different methods to reliably interact with that system and size your bets when things are a little more advantageous versus when they're not, for example, going back to zero DTEs, if I see a blowout range kind of day and it's just oscillating heavy back and forth, and I don't see that priced in enough into the 0-day vols, that's a either small trade day or a no trade day. And it's just because you know what you're stepping in front of. So zero DTEs, I like them a lot in this context because it's a non-correlated return, right? The way that I build the book is I have that core holding that I told you about. I have all these earnings plays, typically 30 to 60 a week, that rotate on those during earnings season. Then you have index vol trading like this across different time periods, not just zero DTE. Then you have actual vol trading in the vol products themselves, trading the relationships between short-term vol, long-term vol, term structure. And then you have some directional bets. So the whole idea is just to cobble this thing together, pretend like I know what I'm doing, and then just watch my money evaporate.
Sounds like a typical retail trader. You do yourself proud.
That's right. Keeping it real.
How much automation is involved in what you do?
None.
Yeah,
none. No, I am vehemently against automation in this way. I use a lot of automation to help me on the back end with analysis and updating things, but I insist on being the clicker, the button clicker. And it's because I track very carefully, two different things: what I do and then different permutations of what I might do. And that's through paper trading. But what I like to measure is the performance of what I do against either what I optimally should do or other permutations of that. And what I find is there undoubtedly is still some sort of human element that's very difficult to quantify that still positively impacts what I do on a day-to-day basis. And I've done a bunch of research trying to get to the bottom of it to try to like actually define it. And there is a huge part of the human brain that is a library for pattern recognition.
Yeah,
and
we're very good at that.
Yeah. If you're slightly on the spectrum like I am, you look at patterns a lot and you kind of know them. Yeah. So there will be periods where net, it's just better with me clicking the button. Now, as soon as I see in the outcome that that's not the case, I genuinely would happily just automate it. Yeah.
The gut, right?
It's from a retail trader's lens, it's such a dangerous balance because if you don't develop like an understanding of yourself and stuff like that, it just leads to a slew of awful behaviors. But the way that I try to explain it to people, it's like, again, I use jujitsu a lot because I like jujitsu. And
I'm taking my kids to jujitsu in an hour.
Which is perfect. They should do a lot of that.
My daughter has been doing it. Let's see. So 7 years.
The question is, how long have you been doing it?
I do Muay Thai boxing.
Because you can't have your daughter able to roll you up as a man.
Yeah. She is so strong. I can't. Yeah. I mean, imagine 7 years of doing jujitsu for a kid. And she's very slim, like she's very
but it's
unassuming
strength. Yeah.
And the strength is incredible. And I just know, and she hated it for a while. And I always told her, I'm like, you're going to do this for 10 years and then whatever, I don't care. Right. Then you do whatever. But man, God help the first guy that tries to mess with her.
It's so awesome.
They will never see it coming.
Well, the cool part is
I run the joints for jujitsu.
Yes, you do. You do. You have the joints. There's 70-year-old dudes. There's 70-year-old dudes that I roll with. So yeah, you have the joints. But I lost my train of thought. What were we talking about right before? Oh, back to jujitsu. Sometimes in jujitsu, which you may or may not know from maybe watching your daughter.
I've watched a lot of jujitsu.
Okay. So you know the way that they teach things, right? It's very fundamental. It's very specific. There's a lot of very specific rules you're supposed to follow. Yep. But then when you watch higher level belts, you're like, you just put your hand on the mat. You are trying to pass guard. You put your hand. Why'd you put your hand on them? You're not supposed to put your hand on the mat. Why'd you do that? Right. And then all of a sudden you realize that they're setting traps. They're doing a lot of other things that violate some of the basic rules. I find that in trading. I find once you trade long enough and you develop this relationship with yourself and this understanding in the markets, and it's not always accurate. There's absolutely periods where I will intervene and I'll see like, okay, that was a bad intervention. This is why. Don't do that again. But net balance, I find that when I get that sensation to intervene, it's not like this thing where I know it's not loss aversion. I know I'm not sensation seeking, right? Because like I've trained all these things out. So there's a reason why, typically a good reason. So just like you find in any high level sport where people will violate some of the quote unquote fundamentals that you're like Steph Curry, he shoots shots that anybody else, if they shot that, the coach would be like, yo, just get out of the game. Go stick. You're never touching that ball again. But for them, they're just like, let the boy go because it goes in. So
that's great analogy. All right, let's talk earnings. You trade earnings. Obviously, we're in the middle of earnings season right now. How do you trade earnings first, and then sort of second, what are you seeing that has you sort of thinking that maybe there's some meaning to some earnings and not as much to others?
So far for earnings, it's been a wildly simple earnings season, shockingly. Okay. Yeah. And it was a couple earnings seasons ago where I actually stopped, like after the first 2 weeks, and I rotated all to paper trading because nothing looked right, and I was just monitoring. And shocker, the end of that season would have been net negative pretty big. And That was, I want to say like 4 seasons ago. I can't really remember when. But this season has been much lighter. I always start with, obviously, the banks, and they tell you a lot, right? Because if you think about banks, they interact with everything. So them reporting first is, I don't know why I love that they do, because it's like a gift, because you can get a sense of what they're seeing, right? You listen to the transcript, you go through the documentation, and you start identifying a lot of like little quirks. So for earnings so far, they've been quite mellow, especially given all of the caveats that everybody's saying in the forward guidance about tariffs. We don't know how this is going to work. But GM reported, and they didn't get smashed. We just had Meta go. They somehow, I mean, I guess if you steal enough information.
And guided high on CapEx, which I found surprising.
And, it's just like that, right? Like, if you steal enough information, apparently you can just be profitable no matter what.
So on that note, I urge everyone to read the piece that I wrote in the Journal of AI and Ethics about Facebook and how evil they are. But that's aside, great way to make money, right?
Exactly. And so going through earnings season, all I do is, at this point, I have a pretty deep relationship with most things that I trade. I actually had to institute a new thing for me, because I have a series of names. It all has to be optionable, at least moderately liquid. I'm not that picky, but it's got to be moderately liquid. And I have a whole list of names, essentially, that I trade every season. So I have earnings reports going back 8 years at least for all of them.
Nice.
And all I do is I measure the behavior pre and post earnings on a historic time frame. And then I actually have a model that I built that helps me project potential future movement based on current conditions. And that's been more so powered by AI now via an automation, because it's way easier to just have my analyst called ChatGPT go do a bunch of homework on these things that I typically would do and give it to me, which is sick.
Nice. Yeah,
and
that's great.
Most of the time it's trading short vol through earnings, but there's three distinct methods. The first one is the vol expansion leading into earnings. There's a very defined expansion of implied vol coming into earnings. Super tradable, especially if you're buying a straddle gamma hedging. Now that stocks are no load, it's actually now like reasonable to do. When stocks had byline commissions, it was something that I would do sparingly, only if things were getting pretty far out of whack. And at that point, I normally would just close the trade because the straddle's doing pretty well. So buying coming into earnings, there's certain names out of the total universe that are good for that, others that are not. Then there's shorting vol right before earnings. So like literally, typically right now is when I would be loading stuff on. So about 5 minutes before the close, but I'd rather be here with you. So I forewent. Honestly, I'm not going to lie to you. I was going to say I can't make it if like the earnings looked really good, but they didn't. So I'm not missing anything. So I think we're all right.
I don't want to keep you from burning less money.
It's just like, it's so fun to watch the colors of the flames. So holding through earnings is another one. And then a massive, massive approach flips everything. And it's called post-earnings announcement drift. And you can find things based on certain criteria, rank them based on prior performance. And you can essentially say, if these conditions are met, it is quite probable. And then you can figure out actually and model what the target move might be over the next 3-week time frame, that you'll see pretty significant positive drift or negative drift, slightly different conditions. So earnings is just a wildly awesome catalyst. Now, the one thing I told you that I started doing that I used to not is, because I have this universe that's so defined, every single week I force myself to at least trade minimal viable product on 5 names that I don't have that relationship with. Because I noticed that like my universe was slowly getting smaller and smaller and smaller, because I was just like, well, I know these so well, and I don't know what this other wild card's going to do. And I'm glad, to be honest, because it just has reminded me that it's just such a numbers game, and you need to get enough through.
Okay, and we got a good question here. I'll pop it up. What's your favorite tool?
What is your favorite tool for monitoring options data in real time without having to get in the options chain / analyzer infidelity like me? That's tough.
Yeah.
Because most of the time that I'm analyzing vol will be from the options chain, because that's kind of where you can see everything. There are other cool tools that I use regularly, and Usual Whales is one of them. But I don't know if you would consider that different than going into, Fidelity. It's still like logging into a platform.
The chain.
Yeah, it's still like logging into something.
Do you ever look at like the vol surfaces?
Of course.
Yeah.
Yeah, of course.
What do you use for that?
Thinkorswim.
Oh, you use Thinkorswim. Okay.
Yeah,
I'll plug a friend's product here. There's a friend of mine. In fact, a friend of the show.
I was going to say, I think I know him.
John Wellborn, who has been on here multiple times, he released a product called Volbox, VOLBOX.com, and he visualizes the volatility surface. It's a pretty nice tool.
Yeah, that's sick. Yeah, because in Thinkorswim, it's cool. It's not 3D, so if you can't,
yes, his art. Yep.
Yeah, so it's still really easy to use if you're used to viewing it in 2D, right? So rather than one model, it's just multiple lines across vol and time, or vol and strike. But the main thing I will mention with respect to analyzing, I told you, there it goes. 5607. They did this yesterday. It did this same game yesterday. I have to be honest, I'm tired of this game. This game is annoying.
Yeah.
Just
straight down.
Just off a cliff. Love that.
Wow.
Yeah, great. I'm sure. So back to what I was saying about zeros, some of them will be losses. This looks like one of them. Now, when looking at volatility, I think it's really important. There's kind of two lenses you can look at it from. There's like a general informational lens, seeing what it's telling you. Right? You can tell if we're pricing in a low probability of a high severity tail move. You can see if we're pricing in a low probability of a smaller up move, vice versa, right? You can see all of these things. But there's like the general information thing. But a lot of times I think traders mistakenly start to think that like, oh, if I see this strike higher than this strike, then they have to revert.
Yeah.
They don't. Sorry. So that can be a really annoying way to start lighting money on fire when you're kind of trading this thing that you think should logically revert, and you're like, yo, it's not reverting at all. So it's useful for general information in that way, I think.
All right. Well, this has been fascinating, Eric.
I have a question for you before we wrap.
Right. Yeah.
From your background, what are some of the ways that you might use a vol surface?
How do I use vol surface? I mean, honestly, I think it's more sort of intuitive than I can. It's sort of what you were talking about. Like I like to look at them to see how is the market pricing in tail risk. I think that's like the primary use case for me. And I don't often trade options, but I do like them from time to time. I like to
straight disrespectful.
I'd like to risk a little for a potential banger, and if I see the surface sort of dipping and not pricing in the same kind of risk at the tails that I see, then I'll dip my toes in on short dated options, and usually I'm wrong, often end up rolling them from but
that's
more often than not
that surprises me a little bit for you, because it also seems like why wouldn't you use like leaps or something just for a stock replacement? Are you looking at things that might not be suitable for, or
no? If I want to buy stock, I'll buy stock. I like to own the shares.
Okay, and is it just because you have like a longer term holding expectation?
Yeah.
You want to? Okay.
Yeah, if I'm going to do long term, I'm buying stock. If I'm trading, then then I'm trading options or futures because I like leverage for trading. But I don't spend the time to trade, so I try not to trade.
I see.
If I'm not putting the time in, it's going to be a crapshoot.
Yes.
So I'll usually only go in on very high conviction ideas like Tesla puts, for example.
I see that. Yeah, pretty good bet.
That was a good one.
Pretty good bet.
But but generally, no, I'm taking like long-term holdings. That's mostly it.
I see. Yeah, that makes sense, because that's one of the really cool things about options that I try to make sure people are aware of, at least, is like, if you typically like holding equity, and let's say your standard equity holding is like a year long, you can grab options that are 600 plus days that really aren't going to decay a ton. They still will decay. You're paying for the leverage. There is no free leverage, but it can be cheaper than the opportunity cost of that money tied into something compared to being able to put on multiple names or whatever.
Yes, totally fair.
Yeah. But you do need specific things that work for that. Also, again, depending on what you trade, sometimes the options chain don't go out 600 days, 700 days. If you're looking at something like Palantir, it does for sure. But then there's other names, like right now, if you look at VIX, it goes out to 21 Jan. Plus, don't buy just blind long options in VIX. That's a whole other, I just realized that don't do that. Because it's going to work completely different than you think.
Yeah. That's for sure. Okay, let's wrap it up. Bringing it full circle back here to Canada. Tonight is Game 6 of Leafs versus Senators, Toronto versus Ottawa. Toronto went up 3-0.
Okay.
Ottawa has won the last 2 games, and now it's back here in Ottawa for Game 6.
Are we happy right now, or are we sad? That's really, I just need to know what emotion I'm supposed to have.
So as a Phillies fan, I will never forgive Toronto for 1993. It's not worth getting into, but they destroyed my childhood with a single swing of a bat. And so ever since then, I just want to see Toronto lose.
Okay.
The fact that they are like one of the top seeds coming into the Stanley Cup playoffs, and Ottawa just barely squeaked in, and now is winning games in this series. Let's go, go Sens, go! Let's see Ottawa come in for the upset against Toronto. Yeah.
Okay. That's good. I just need to know. I'm always down to hold a grudge. So
yes.
Yeah.
There you go.
Yep.
All right.
And
okay.
Our zeros, not a full loss, just mostly.
Okay, good. Mostly, but better than not a full loss. All right. Thanks so much, everyone, for tuning in to Let's Talk Markets. Thank you, Erik. Always appreciate you. Always a fascinating conversation and a different perspective than we usually get. That is not a lie. And join us next week. We're going to have an interesting episode next week. So we have a data provider for some of our market data research here. They're called BMLL. And their chief product officer is going to come on. And we're going to get deep into market data, super fascinating, but like he's going to show us the analytics on the data that they perform. And we're going to talk about the impact of tariffs, how it comes through in the data, and some other fascinating metrics and trends that he's seeing in the voluminous amounts of market data that they collect, including opera data. So I think that's going to be a nice, fascinating conversation. So join us next week. Again, thanks, Erik. And thanks, everyone, for tuning in, as always.
Hasta.